I think it's a steal to be buying silver sub $30. Silver is the cheapest metal on earth, and I am as bullish as it gets in the metal.
Please join us for our next live stream Sunday, May 9th at 9 p.m. Eastern. We'll go over current events, past guests, and of course gold and silver news. Once again, our next live stream will be Sunday, May 9th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to our channel or if you haven't already done so, please do subscribe. Hit the bell to be notified on new updates and give us a thumbs up if you like what we do. We truly do appreciate your support and thank you for it. Tavi Costa returns today. Tavi is a partner and portfolio manager at Crescat Capital, a global macro asset management firm based in Denver, Colorado, that focuses on the most compelling macro themes. Tavi is highly regarded for his views and performance reports, charts, and analysis, and his research has been featured multiple times on financial publications such as Bloomberg, the Wall Street Journal, CNN, and Reuters. And we're delighted to have Tavi back as a return guest. It's time to saddle up and silver up for Tavi Costa. Hola, Tavi. Welcome back to SBTV. Tutto bem.
Great, Patrick. Thanks for having me again. Looking forward to this.
Thanks for coming back on. We appreciate the time that you're giving us once again. You know, Tavi, in Crescat Capital's Q4 2020 quarterly report, your firm said the stage is set for a massive investor shift out of overvalued mega cap growth stocks and fixed income securities and into undervalued materials, energy, and other commodities. And we believe it is the dawn of what we are calling the Great Rotation. Two things. Can you explain what the Great Rotation is and why was it named the Great Rotation?
It's the Great Rotation. It all comes down to that commodity to equity ratio, which is at over 50-year lows historically here. So, we saw recently this commodities market starting to heat up. So commodities index had really broke out in December from a 12-year resistance, which I think was very important. And since then, it's now, it still looks as strong as an X. And I really think that the beginning of this was all sort of a reflationary trade being priced in, which implies sort of a healthy recovery from the prices in assets in general. So I think probably what we're likely to see now, it's not the continuation of the reflation, but more of a stagflationary environment, which may have impact on the market leadership. Technology companies being a large one, where I think very strongly what we're going to see is that natural resources stocks are going to start taking leadership. We saw this year to date so far. Energy sector is the one leading the entire market by far, actually by over 5 to 6 percentage points already. And so, I think this is just the beginning. We've had cost of capital declining for so many years, which allows investors to not take really put as a priority profitability. And so we're seeing technology software companies that are actually profitable, not relative so much with their valuations are a bit out of touch in regards to what we've seen historically, and it looks a lot more of a speculative bubble scenario than highly profitable businesses, which again they are profitable, but doesn't look as good in terms of multiples. And so I think we're about to see a shift towards cost of capital rising, inflationary forces beginning to pick up, and that will change the market dynamic. It will change the market leadership. Inflationary thesis is a high probability of entering here, and will have an impact. If you look back throughout history during inflationary periods, 1910s and the 1970s, where both of them are very pronounced periods of median CPI rates above 6%. And, I know CPI is not a perfect way to measure those things, but it's a good gauge historically to at least have an idea where we were. And during those times, we didn't see risky assets such as equity markets doing very well. They only went up by about 1%. In real terms, they actually had negative returns. So this idea that stocks do very well during inflationary environments is not very true. So this all goes back to the buying commodities and selling equities. I think that's the great rotation. that is probably going to happen in the following 5 years or so.
You have a chart titled Growth versus Value Stocks, and it shows the steep and rapid plunge from the peak of 40% of the tech bubble in the late 90s to negative 40%. Did you look into the cause of the steep, rapid plunge, and was it let's say, a panic or a stampede out of overvalued stocks?
You asking back then? I believe, well, if in 2000 certainly was driven more from a much steeper decline of the growth stocks and the high multiple stocks of the time relative to those. It wasn't that value stocks were actually diverging and actually, in other words, completely negative correlated to the environment. And so what we saw was just value stocks outperformed, but actually also declined during that period. Right now, we saw an inflection point since elections where it really was since the vaccine news that came out, where value stocks begin to do better. That's that reflationary environment that we tend to see from very depressed prices. So we saw, value stocks doing much better than tech stocks. And then once we get to this recovery levels back to normal in terms of historical prices, that's when the economy starts to ask itself, are we going to see a reduction here in prices again, or are we going to see more of inflationary forces building up? I think it's the latter. And that environment, it completely changes how risky assets tend to perform in those environments. So, rising interest rate or rising inflationary environment is not positive for high multiple stocks. And a lot of the value stocks that we see goes back to the commodity related names. A lot of those companies are in that space. So I think that there's, again, a case to be made where the value attractiveness of those resource stocks look much better than for tech companies. Now, I've looked at this before, but if you just look at gold miners, free cash flow yield today is actually looking higher than tech companies in general. So in other words, the so-called skepticism of the so-called capital destroyers, precious metals miners, is actually making more money or actually more attractive relative to their the size of their companies compared to tech companies. So this is a big shift, because I believe that the next growth stocks of this environment will be a lot of the gold companies. It is true that it's a value space, but also embedded with a lot of growth. And so we're seeing free cash flow growth of the whole commodity space picking up recently. We're seeing underlying prices of those commodities improving too. So I think those are all the factors that are really inside of this ratio you're referring to beginning to fall. In the leadership in the market, as I said before, with energy taking over recently, I think there are better opportunities than energy in other places, but especially monetary metals. But it's interesting to also be looking at almost any other commodity. Tangible assets are probably in a good place here for the following years, given what we're seeing in the macro environment.
And given that the economic circumstances are different today than it was during that tech bubble back then, when do you expect a similar turning point where we will see a sort of a panic this time around, away from overvalued stocks and into undervalued stocks?
Usually those things happen under the surface. I mean, it's not 1 or 2 days. It's progressively happening, and I think it's somewhat already happening. I don't know if it's the end of it, but it's certainly, if you look at software companies, a lot of them have been doing very poorly. We're seeing SPACs doing very poorly. We're seeing the Coinbase IPO actually not performing as well as since the actual IPO. We've seen even the crypto market, which has become more speculative for the right or wrong reasons as of late. Also, taking a break from what we saw since the beginning of the year. Still up 50% year to date, so still incredible performance. But we're starting to see some of those signs already happening. That's exactly what happened in the tech bust. I mean, the tech bust was the beginning of all. Was really the tech sector that began to diverge from the rest of the economy, and then we saw really spreading out to the whole system, where investors began to lose faith in growth And that's that's really the will cause the end of the business cycle. We do have a different environment today, given the policies that we're seeing in the monetary and fiscal world relative to what we saw back then, which creates, and that's where I think. I mean, I always try to think about a probability game here, where I think there's a high probability that all this, highly speculative issues that we're seeing in the assets, especially equity markets, corporate bonds, sovereign bonds, it is per se deflationary, but it's also being paired with highly inflationary responses from the government side.
Yeah, you touched on something, and that's where people are right now. They're kind of wondering, are we going through deflation, disinflation, inflation, and guys, they're just all over the board right now. But you're looking at inflation.
Well, I think I think there's a very high likelihood that we may see that happening here. It starts with extreme policies that we're seeing, especially with helicopter money, where the population is really discouraged to go back to the labor market at a time when you're already having long-term trends of reduction of labor and also underinvestments in the commodity space. And so that issue will exacerbate and magnify the price of commodities and will create inflationary pressure. And bear in mind, we're seeing the largest wealth transfer we've seen in history. The government is giving money to the population in a way we've never seen before, and different than a lot of the popular narratives that we hear. Is we're seeing the largest net worth increase by the bottom 50% in history in the middle of a recession or a depression, whatever you want to call it. And so, even though, the inequality problem is a big issue, when myself coming from an emerging market, I know exactly what happens when you give money to the bottom 50%. They tend to spend. So how do you fix this? We're having unusual demand coming out with extremely constrained supply. And so in order to fix this, you have to sort of stop this trend that we're going through with universal basic income trend, which I think it's almost impossible to stop that from now. On top of that, we're seeing central banks basically at the mercy of broken governments worldwide. So we're seeing a tsunami of sovereign debt issuances, and central banks, especially the Fed, are basically trapped. So they have no choice but to continue to pump in liquidity in the system to suppress interest rates and allow the government to continue to spend money and borrow money at very cheap levels. And enable the second part that I think is important is to really enable investors to justify buying assets at record valuations. So what is the result of all this? Now, the result is that we're seeing now the population hoarding hard assets, regardless of what they call hard assets, even is some crypto assets or commodities, regardless of what that is, lumber these days, and it's creating a self-reinforcing loop where higher tangible assets drive higher inflationary expectations and also higher consumer and service prices. And so there is nothing transitory from this. And when you listen to the Federal Reserve, that's the message, that all this is going to go away. I really don't think it's going away. And when you look at the agenda politically, especially with the green agenda, really suppressing again the development and exploration of natural resources, mines, and so forth, I think this only adds to the problem. So the macro and political and market environment has never been so bullish for tangible assets, especially gold and silver. So I think there's a rush from not only innovators and the whole world, really, the population, to go from the old to the new economy, but there's really not a viable plan to do so. And so this green agenda is really adding to the problem. So there's a lot of moving parts, but in my opinion, it leads to higher inflation. And so I'm very worried that we may be entering a long-term inflationary problem this next decade.
Yeah, I completely agree with you. I mean, we have the Fed on one side where pretty much they want that velocity of money to kick in. They want that inflation. And on the other side, you got the government, they're going to give out infrastructure type jobs and other things like that. So politicians are happy. The people are going to love them for giving them work and money, and the Fed's going to be happy that they're going to get their inflation. And short term, I think people are going to be happy, but long term, that inflation is really certainly going to come back and bite everyone. But Tavi, in Crescat's March research letter, it said, according to our models, the entire universe of stocks is more overvalued than when it was back in the height of the tech bubble. Is there a stock market bubble? Well, I think we know the answer is yes. But is it larger than the tech bubble of the 90s?
Well, it is per se, but it also the differences in the macro drivers of that justify those valuations are different than what it was. But that doesn't change the dynamic, because what we're seeing is a regime change in terms of what's happening with the market. As inflationary forces pick up, valuations will begin to matter again, and fundamentals will begin to matter. So I don't think a lot of investors are really catching on to that change just yet. So yes, I think there is certainly a case to be made that we are in the biggest or largest speculative bubble we've seen in terms of the equity market. And I really don't think it's coming from the large companies. The FANG stocks of the world are actually looking much more attractive in terms of valuations than the rest of the market. It's coming from almost most sectors with very unrealistic expectations of fundamentals or just actually actual numbers in terms of the enterprise value of relative to the sales and revenues and earnings and free cash flow of those businesses. And you really can find that when you look at those metrics on a median basis, because a lot of the aggregate numbers are actually encompassing a lot of those larger businesses. And so they really skew the whole data when you look in average terms. And so the median calculations certainly are completely off the charts, even relative to plot that relative to interest rates. And so I really think that there is a bubble. The real question is when it pops and what happens. It really creates this great rotation environment where for the first time for the first time since '08 and since the very peak of the tech bubble, we're seeing the yield, the earnings yield for the Russell 3000 now, at a negative terms relative to inflation. And that's using CPI, which in my view is completely understating what's really happening in the system in terms of inflation. So what it causes is a flow out of very highly speculative assets to something that actually have the potential of appreciating in price rather than yielding something, because there's no yield to be found. And so for me, it really creates an environment for large capital allocators to be looking for tangible assets. This is the perfect environment for things like gold, silver, and even copper and oil, and other more cyclical commodities that may actually benefit from this. And so it is an environment where you want to be looking for, as you become constructive on those commodity prices, you want to be looking at companies that actually work in the space. And so for us, it's been, we've been going very deep into the value chain of a lot of the miners in the gold and silver space, but there are a lot of opportunities elsewhere too. And so I think that's really what's going on. And I'm very worried about the overall equity market. I've been worried for some time, and I think it's prudent for investors to be looking for cheap assets and not expensive ones, especially when you're seeing under the surface this change in environment where, in my opinion, a lot of investors are just ignoring the risks of the prioritizing, especially profitability, which hasn't been the case for the last decade, as all of us know.
Okay, cheap assets and precious metals. We'll touch on that in just a bit. Ray Dalio said in March this year that his firm's models, they show that the stock market is a bubble halfway to the magnitude of those that triggered the historic market crashes like the dot-com bust and the Great Depression. And this sounds very different from what Crescat said, that the entire universe of stocks is more overvalued than it was at the height of the tech bubble. So my question here is, why are there different views of the magnitude of the overvaluation in the stock market, and are crash signals not what they used to be, given the great variance in interpretations?
Well, I think the big reason for that is first, we're seeing larger and larger policies going back, in terms of monetary and fiscal policies, going back, especially since the 80s. When central banks really began to intervene in a larger fashion, and we're in terms of trying to avoid the changes in the business cycle. That's something that really was a shift back in late 80s, and now it's been increased over time. What we saw in the global financial crisis is not even close to what we're seeing today. And this dependency on central banks to continue to prop up the equity markets, which became a new mandate for central banks, is to ensure the lack of volatility in equity markets, and a perfect world where equity markets don't fall apart given the current valuations. But the problem is that by doing so, they're also triggering a lot of inflationary forces that may be difficult to and may not be transitory, as they are referring to in the last statements and interviews. And so I really think that that's the big issue. I did look into the Ray Dalio's research in regards to valuations, and the difference is that the depth of the research, and with all the respect, was a little bit more diversified. The way we're looking at at least 20 factors that we like to combine. In one of the models that we put out in our letters, we just used about 15 or 16, if I remember correctly. But we looked at a breadth of a lot of indicators to come up with those numbers, looking from an aggregate perspective, from a median perspective, from an average perspective as well. We try to be fair to really see what's going on, and also adjusting for margin, right? Because it's important to see them. Companies tend to have peak margins at the peak of the cycle, and so by looking at a lot of times in price to earnings, you may not see that if you're not adjusting for the margin cyclicality. So I think it's important, and that's the difference between our research. But it really comes down to the fact that it doesn't really matter if it's the most overvalued. I think it really comes down to it is overvalued, and it is a bubble at the end of the day. What investors should be more concerned is when is it going to pop? And the more we see those inflationary forces building up in the system, I think the bigger risk for those risky assets will become. And so, I'm worried about this, because I think what we saw back in 2020 was this break from reality, where financial markets are at one place and the real economy is in completely another space. And now in 2021, we may see the same difference. However, the economy may do a little bit better, and what we may see is a complete change in financial markets that already have that positiveness already priced in the system. So I'm worried that that's going to be the case, and we're probably already seeing most of the returns for perhaps for the year for the equity markets. So I think it's a dangerous game to be trying to catch on for the last breath here of what we may see. But I'd much rather spend my time looking for cheap and attractiveness in the resource space, natural resource space, such as gold and silver.
Crescat's March report also highlighted that the trigger for the last two recessions was the Fed tightening liquidity as the economy heats up. But do you think the probability of this scenario happening again is significantly smaller? Can you explain why you expect the Fed to keep monetary policy loose, and why will the trigger for the next recession be different this time?
It will probably keep it loose because it sort of knows that it did in the past what it did in the past, in terms of, not that the Federal Reserve learns a lesson from prior mistakes, because clearly we've seen those same mistakes happening over and over again. But it certainly seems to be the case, this reluctance on really tightening the economy here, given the valuations of assets and where the economy really is. I mean, it's not like we're cleaning up the economy. This whole narrative of the roaring 20s is just completely off, in my opinion. We're just seeing a relocation of the macro imbalances from the private sector to the public sector. So the government really is the one taking on all the issues, and why we're seeing the debt increase on the government side, while balance sheets of households have actually improved. And that's just all data, factual numbers. And so I think it's going to be more likely to see the continuation of those easy policies, and therefore why I believe it's going to play out different than 2000 and 2008, in the case of what we saw, sort of a beginning of a kind of inflationary forces building up, immediately cut by the Federal Reserve with tightening policies that then triggered the equity market to collapse. I don't think that's going to be the case here. I don't think they have a choice in order to do that. By tightening, it would really cause issues in the bond market. And I think that the bond market is not ready for anything like that. And the Federal Reserve is very much in line with that knowledge. And so I think that the Federal Reserve now has the mandate of suppressing interest rates going forward. And by doing that over time, it will continue to trigger this hoarding process of assets, of tangible assets, rather than owning cash. And so, yes, the famous phrase from Ray Dalio, "the cash is trash." I think he's right. I think in terms of that, we are seeing a shift. I mean, the whole reason people are not buying Bitcoin because they want to go to the next coffee shop and buy some coffee with Bitcoin. They're hoarding assets because they don't want to hold cash. And so I think that trend is just at the beginning. And while a lot of people see even the popularity of the word inflation on Google Trends as being spiking, as maybe we're about to see a mean reversion of that, where the popularity may die down a little bit, given what we're seeing in terms of everyone talking about inflation. I think it's quite the opposite. We're seeing an environment very similar to the 1970s, 1910s, which the supply issues in the system are much more permanent than transitory than most believe. And so this is a much more long-lasting consequences of not only a decade-long issues of underinvestments in the commodities, but also the government and central bank policies that are magnifying the problem. So I think we're very much in the place where we could see inflationary forces really starting to brew even further. So far, it's been I think it's been notable, but I think it's going to go. It's probably going to continue to go higher. And so that's going to change the whole market environment. You can't think of a high multiple company doing well, a high duration asset such as a technology company with multiples of 50, 60 times sales doing well in an environment where inflation has to rise because the central banks cannot fight inflation. They actually have to allow it to run hot. So by allowing the economy to run hot, that is going to be changing the whole market and macro dynamics. So I'm in line with much more that we may see inflationary forces building up, and will create this really bullish setup for commodities relative to the overall equity market.
Okay, so do you think the Fed will have the guts to raise rates once we start seeing this?
I don't think so. I think they're going to have to. We're going to see other excuses of why this is transitory. So I don't think that's going to be the case. I think probability for tightening is much lower than most believe. In fact, if you look at the euro dollar market right now, it's pricing in the probability of one hike in 2021, 2 hikes in 2022, and 4 hikes by the end of beginning of 2023. I don't think that that's going to happen. I really don't, because I think that we may see is the economy running hot for longer.
Tavi, what do you make of the Fed's increased purchases of treasuries and mortgage-backed securities, and how do you see this path of debt monetization end?
Look, I think this all goes back to what's going on with inequality issues. When you look through who owns real estate, and actually the assets owned by the bottom 50%, about 40% of what they own is in real estate. So it is a big importance for the government to prop up the housing market, to also improve the inequality issues. For people that don't know, about 90+% of what, or 80+% of what the higher, the richer parts of the society own, and mostly financial assets, and not so much housing actually. And so that's the big difference between the two. And I think that by doing that, it also it creates an environment that is per se in a way possibly bullish for some financial assets, not all of them. But I think that's basically what the government policy is to prop up the equity, the housing market. That was the big issue that we saw back in 08. From 08 all the way to 2011, the net worth of the bottom 50% declined by 84% back in the global financial crisis. And the big reason for that was because of the housing market. And so I don't think they're going to make the same mistake again. I think what they're trying to do is allow the housing market to run hot as well. And so I think, given the lack of inventories, I know this is very regional, but in a lot of places in the U.S., we're seeing a lack of inventories of housing. I think we're going to see increasing prices continue to happen and continue to prop up, especially the net worth at the bottom 50%, along with the other richer parts of the society. I think that, so that is a part of the inequality agenda. And so, I don't think that that's going to change any time going forward.
You've also shared a chart of silver's performance during the last Democratic sweep. Silver rose from 327% during the Obama administration between 2009 and 2011. And we now have a Democratic administration in power again on both sides of the aisle. Do you expect a similar performance in silver again in the coming years?
I do, because on top of what's going on there's also the supply issue that I was referring to recently. But if you just look at the production of a lot of the capex of spent on the mining space of silver companies, which is hard to pinpoint what is exactly a silver company, as it's really a lot of times a secondary part of production of those businesses. But doing your best to calculate the capex being, really spent over the last years in the space has been actually declining while silver prices have been rising. Now we saw a decline of about over 20+% of capex for silver producers back in 2020, while silver actually went up over about 50% in a year. How many times do you see that throughout history? So there are supply case here that is very strong. The lack of discoveries in the space is a second part that I think it's a big deal. The lack of spending in exploration and production, especially exploration to find those new deposits, is a big deal that is also causing this issue. And so, and also, even this recent move towards deglobalization, which in my opinion is also very inflationary going forward. So yes, I see a lot of problems in regards to the supply side of things that may, really intensify this move in gold and silver. Now, the demand side of those commodities are really being driven by the macro imbalances. I think those macro imbalances are what creates the need for a lot of investors to buy tangible assets, especially gold and silver. And so what we're seeing in terms of that may not change. So the government spending situation may continue, as I have a strong opinion on that. We'll continue to see helicopter money policies. The Federal Reserve has no choice but to continue to pump up liquidity, suppress interest rates. So all that is happening at the same time. So, I think this is as bullish as it gets. And when you have a pullback like we just saw recently, in gold and silver, it's the time to come in and take advantage of. That's when the good investors, the investors that are successful in the space, tend to really take advantage of this is during the pullback.
Yeah, earlier you touched on picking up cheap commodities, and Crescat calls silver the cheapest metal on earth. How did you arrive to that conclusion?
Well, you arrived at that conclusion given the need for silver and the aspect of being also a monetary asset. I think that's how you do it. And given, not only, there's issues with the stock to flow research in regards to silver compared to things like gold. But I think what the point is here is that, gold really is in a secular bull market in our view. I think that's being, in our opinion, is being identified by what's going on in the macro world and the political environment and what we may see going forward. So by identifying that we are in a secular bull market for gold, you want to be long silver, which is the high beta version of that asset. And so I think that's an important portion. The second part is the supply constraint issue that I was referring to. I think that really is a big part of why silver is incredibly cheap. And then when you chart silver relative to equity markets right now, Russell 3000, you see a perfect double bottom of the silver to equities ratio, which is, for me, is also very attractive. You look at silver relative to money supply, you see the same issue. And also even the gold to silver ratio is also out of whack historically. So a lot of reasons to own silver. I think it's one of the most asymmetric opportunities of the next 3 to 5 years. And I think it's a steal to be buying silver sub $30 an ounce. I mean, who would have thought that we'd be printing $3 trillion of money in less than 12 months, and the deficits would be where they are with interest rates as low as they are, and still see silver below $30 an ounce? I think that's an absurd. Not to say what's going on with the CapEx situation and the almost record negative sentiment in the space where investors are thinking that silver and gold are going to be replaced by Bitcoin. And so it's like the perfect storm here for those assets to do well. I couldn't like silver more than what I do. I really think the silver is the cheapest metal on earth, and I am as bullish as it gets in the metal.
We're expecting gold to really make a move. Have we reached maximum negativity in gold sentiment, and do you expect that turning point to come soon?
Well, how do we reach that? Well, I think it started with nominal rates rising faster than break-evens. First of all, I think that was the big reason what caused this pause in the gold market, which happens, by the way. If you look back in the last bull markets that we saw, it's normal to see a pause in the bull market, and that's what gold does. It takes a pause, and then it does other massive moves after that. And we never know when the market is sort of ready for a pause. And I think it just seems to be a rush towards extreme returns by investors in general. Where I mean, I've had cases that I've been wrong, macro cases that have been wrong, where it actually went against my position. In other words, I was bullish on something and the asset actually depreciated in price. In this case, we've only gone sideways, really. And there's this record pessimism with all the macro drivers that have not changed. I mean, the macro thesis behind buying gold and silver and miners is unchanged. In fact, even the miners, when you look at their fundamentals, are really improving. Look at free cash flow aggregate is at a levels that we've never really seen before in any other decade. So why? Because of this skepticism forcing those mining companies to really cut down cost and improve profitability. So this is really, I mean, I've never seen the big miners so cashed up to make acquisitions and completely change this industry going forward at a time when really Apple's market cap is almost 4 times the size of the entire precious metals industry. So there is a lot of negative sentiment being driven by especially the developments in the crypto markets, which some of that are rightly so. I mean, Bitcoin developments in the crypto world is definitely taking off, and there's no judgments to what's happening in that space. I think there's some very good opportunities there as well for a lot of investors. But I tend to focus on something that is not really popular in the narrative here of the market. And I think precious metals are certainly fitting that category right now. And so I think that we're starting to see a quiet move here of strength in the gold and silver market, especially in the last few weeks and especially few days. And might be the beginning of this of us resuming the bull market. And so, you look at the miners to gold ratio improving significantly. Those are all signs, strong signs of investors going up on the risk curve instead of buying the underlying metal, believing there's much more constructive narrative going forward and trying to buy up that riskier parts of the space, and that's the miners. And so the improvement of the mining to gold ratio is incredibly important. So yes, I am I am again as bullish as it gets in the space, and I think it's time for investors to really be taking advantage of the pullback, and hopefully I think there's going to be a lot of asymmetry and a lot of opportunities macro-wise in the space.
Hey, last question here. If you could explain how the gold supply cliff complements Crescat's activist gold strategy.
It complements in a huge way because of the depletion of the reserves in the big miners. It really is aligned with the fundamentals improving of those businesses. So basically what's going on is when you calculate the probable reserves of those provable and probable reserves of those larger miners, it's normal. They're producing, so they have to be depleting the reserves. And what we're seeing is not the lack of discoveries. No large new discoveries of gold and silver in the last 3 years. And by large, it's over 2 million ounces of gold. And so We're seeing the budgets of exploration still declining relative to where metal prices are. We're seeing capex in the gold and silver space doing the same, contracting rather than rising. Those are not normal trends that you see. Gold is not too far from being at record levels in prices, while we see capex completely off in terms of that. The optimism in the actual price of gold and silver, especially for the last 5 years or so, it is not being reflected in the mining space. So at a time when I think when you look at the balance sheets of those larger miners, they are improving for the first time. They're using so basically, if you looked at about $15 billion they created of free cash flow in the last 12 months, about 60% of that was used to pay down debt. As you compare that with 2011, where we saw a complete different scenario where they're leveraging up their debt, their short-term and long-term debt was actually increasing at the peak of the market, while we're seeing the largest repayment of that right now. So the differences are absurd relative to the peak of the other times in the mining space. And so we're seeing improvements of free cash flow. We're seeing not only that, but the free cash flow yield of those businesses being more attractive than tech companies that I was referring to earlier. So I think that there's a case to be made where those companies are really looking a lot stronger balance sheet and fundamentally in general wise, that may be looking for new acquisitions especially in the exploration and discovery space of the mining industry. And so Crescat has been focusing mostly in those geographic locations where we can find very prolific gold and silver deposits worldwide. And we've been focusing on a lot of those district plays where we think owning gold and silver in the ground is the most levered way to take advantage of a gold bull market, especially at its early stages of the cycle. So I think that's really the reason. So depletion of reserves, the issue with finding gold at the same time being met with money is actually improving, the fundamentals improving of those miners, the marrying all together, for me, it means that we are at the very early stages of the gold cycle here. You don't see those types of corporate behavior at the late stages of the cycle. We're still paying down debt. We're not leveraging up the out.
Okay, Tavi Costa, before we wrap up, can you let our listeners know more about how they can find your work and Crescat Capital?
They can find my work, Patrick, on Twitter at Tavi Costa. I'm very active there. I post a lot of macro charts and ideas that we're getting involved. You can also find videos on YouTube of our activist ideas on the gold and silver space with the mining companies we're getting involved, which we do it every Friday at 2 p.m. Eastern. And you can find that on YouTube if you type Crescat Capital or Tavi Costa. Those are live presentations. I'm also very active on Instagram at Tavi Costa Macro and LinkedIn. So I basically post the same ideas. Oh, and there are ladders. I think for people that are new and never looked at our stuff, our ladders are very in-depth, and we go really deep on those macro thoughts that I was referring to in this interview. So you can find that at Crescat.net is our website, and you can find all of our research pieces in that website. Thanks again for having me, Patrick.
All right. Thank you also, Tavi. We appreciate you coming on the show and hope we can do this again soon.
Absolutely. Thanks.
That was Tavi Costa, partner and portfolio manager at Crescat Capital. For more of his information about his work and his views on the economy, please visit the Crescat Capital website, crescat.net. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.